Taimur, really good having you. Thanks so much for joining in. I hope the US trip was successful in ways more than one.
Well, indeed. I mean, the interest in India remains very high among investors, no doubt about that.
Oh, wow. That's good to know. Actually, so let's start with that and then we'll come to the policy, Taimur, and your take on the policy. But since you're mentioning that, we are all trying to get a sense of how investors are looking at India because of what's happened to China, because of relative valuations and a lot more. What did your discussions there throw up?
Right, absolutely. That's the key here. It's all relative. I mean, when you think about India and the fact that, the GST is, running into a lot of problems, land acquisition may not happen, there are a lot of things where expectations were high, we're not getting there. But when you look what's out there outside of India, Brazil and Turkey and Russia and China and Indonesia, and all of a sudden India looks like a million roses. So that narrative is still fully ingrained among foreign investors. They may be a bit disenchanted with the structural or rather the lack of progress on the structural side, but at the same time, from a cyclical perspective, they still see India in a much stronger plane than just about any other major EM economy. And that, I think, compels them, both on the fixed income and the equity side, to remain interested in India. And so you see it across the investor class, whether it's hedge funds, mutual funds, or large asset management companies from the real money side, interest in India remains substantial.
What's the nearest competitor, though, Taimur? If anything were to go wrong, what's looking relatively a bit better than the rest of the world?
Well, you see, before the commodity correction came, we always used to say that, lower commodity prices is an unmitigated positive for an economy like India. But now that we do have substantially lower commodity prices, we realize that even within India, there are a lot of stocks and a lot of companies whose fortune actually wane with weak commodity prices. So whether you think about a commodity refiner or an exporter, they're of course having a torrid time. So from that perspective, further downside to commodities clearly is a risk, not just for the Brazil and Indonesias, but also for India, at least certain aspects of the Indian economy. But beyond that, from a relative scale, I mean, the story in my view for the second half of 2015 and going into 2016 would be countries that can offset this global lackluster external demand environment with strong domestic demand supportive policies. And therein lies some competition for India, because the Chinese are not sitting idly. They will pump prime and they will try to get domestic demand going, because they also are not seeing much of an upside on the export side. Similarly, you will see Indonesia with President Jokowi, who also came to power in Indonesia, just like Modi came to power in India, also has very ambitious infrastructure spending plans, and that might be another source of strong upside, if you will, as in terms of an economy trying to get its domestic demand going. So if India fails in that competition, everybody is facing exports headwinds. So the winner, in my view, is the country that does the best in propping up domestic consumption, domestic demand. And if India sort of slips on that, then of course you can say going forward, the Indonesias and Chinas would be more attractive. But right now, on a relative basis, India is still ahead.
Taimur, for the longest time, everyone thought that India was more like a IT and pharma story, more like an intellectual or service export dominated economy. But late last evening, we understand that iPhones will be made in India. Bajaj Auto is now exporting about 1 million bikes out of India. India has sent a ship to to Mars. So one is getting a sense that soon the entire manufacturing exports are also picking up.
Well, this is an ongoing phenomenon. I mean, you mentioned Bajaj. I can also mention Mahindra & Mahindra, which has been very successful in exporting their equipment to all over the world, including China. You can think of L&T, which has basically, financing, or rather exporting the entire core of the infrastructure boom you see in the Middle East, whether it's rigs or cranes and so on that come from L&T. So Indian manufacturers, for better or for worse, have been at this game for a while. And when you look at the export performance of India, it's not just gems and jewelry. Those light manufacturing products also are, an important part of the dynamic. I think that we should sort of pay attention to what Governor Rajan said last year on his critique of the Make in India concept. The idea of having a manufacturing base is very important, but one also has to be cognizant of the fact that external demand for those manufacturing products may not be as strong given what is happening globally. So the sort of success that the ASEAN countries had, or China has had in the last few decades, India will struggle in that area. And therefore, I go back to my earlier point, that the challenge in order to outperform going forward would be to revive domestic demand. Now, that manufacturing could be just make for India, as Governor Rajan had said. So whether it's Xiaomi coming and building phones in India, or even Apple, Foxconn coming and building iPhone products or components, there is a large enough domestic market. So as long as there is employment and wage creation for the domestic market, India can get very good, strong growth based on domestic consumption-related activities and investment. And so that's where I think the recalibration or retweaking needs a little bit. We're not talking about India becoming a big export powerhouse on the manufacturing side. We're talking about India becoming a big production house for domestic demand for India.
Sure. And how crucial would the RBI action be for promoting all of this and more? Because yesterday we got a hint that while the RBI is not concerned about inflation too much, the forecast is down, the Fed hike remains an overhang. At least that's what came out of the commentary as well.
You know, I frankly do not think the structure of interest rates or the direction of RBI policy will make or break India's manufacturing future or the cycle. I think the cycle is usually dependent on a number of things. Global demand, which is lackluster, and therefore I'm not very optimistic about a major cyclical recovery of growth going beyond 8%. But then there's the issue of domestic policy, structural and cyclical, mostly coming from Delhi. That will help competitiveness, wage growth, domestic manufacturing, and so on. And there one can be cautiously optimistic. And again, I think the job that the RBI needs to do is keep inflation expectations low. As you said earlier before my segment, that domestic consumption is being helped by the fact that inflation has come down, and that's where RBI needs to keep a strong role. It also should be able to maintain rupee stability, which is also very, very important for the large Indian corporate sector that is leveraged in US dollar terms. You also need to have domestic and foreign investors being excited about India, whether it is external balances or rupee or the inflation outlook. So those are the areas where the RBI can play a strong role. In my view, it's not the structure of interest rates that is that big a deal. We had far worse interest rate dynamic in India 10 years ago, and you had very strong growth because at that time the ROE was on a typical project 25%. Even if you have double-digit interest rate, not a big deal. People will borrow, people will invest. Now you have significantly lower interest rate and still people don't borrow and invest because there are bigger macro drivers as headwinds as opposed to just the interest rate cycle.
We're so glad you could take our time and speak with us today. Always a pleasure having you on the show.
My pleasure. Thank you.